All right, in today's explainer, we are tackling a really big one, IRCTC. It's a company pretty much every Indian knows and uses. But you know what? Its stock performance is a total puzzle. So today, we're going to unpack a deep dive report that claims it has the answer. Okay, but before we jump into the thick of it, just a quick but really important heads up. This whole analysis is for educational purposes. It's based on AI crunching public data. It is absolutely not SEBI-registered financial advice. We always encourage you to do your own research before making any moves in the market.
So, that brings us to the central mystery here. How on earth does a government-backed monopoly, a true giant in its space, watch its stock get completely hammered? I mean, that's the big question at the heart of this report, and we are about to dig in.
And just look at the scale of that drop. We're talking a fall from a high of over 820 rupees all the way down to around 511. That's a massive 38% correction. You know, when a blue-chip monopoly stock falls that hard, you have to sit up and pay attention.
And this is where it gets really interesting. This is the core idea of the analysis we're covering. While the market is clearly punishing this stock for whatever reason, this report comes out with a really bold, contrarian view. It says the market has got it completely wrong.
So let's dive into this huge disconnect. The report basically argues this 38% drop isn't a red flag at all. It's actually a potential window of opportunity for investors who are paying close attention. And the report doesn't beat around the bush. It gives a clear buy recommendation. But, and this is important, this isn't for day traders. This is for patient investors, people with a 3 to 5 year view. And the reason? Well, it's simple. The analysis calculates the stock is trading at roughly a 40% discount to its real value.
So where does all this confidence come from? It's really rooted in the company's core strength, specifically what investors call its business moat.
See, at the heart of IRCTC's power is this idea of a regulatory monopoly. This isn't a company that just built a better product and won. Nope. This is a company that has been given the exclusive, government-mandated right to do things like online ticketing for Indian Railways.
And this quote from the source material just perfectly captures how strong this position is. This is not a moat that competition can erode. It requires an act of parliament. Just think about that for a second. A competitor can't just come along and build a better app. To break this monopoly, you would literally have to change the law of the land.
But look, an unbreakable moat is only half the story, right? It's got to be backed by some rock-solid financials. So let's get into the numbers that this report calls, well, truly elite.
First up is this incredible number, a return on capital employed of 44.4%. To put that into perspective, anything over 20% is considered really, really good. A number this high suggests the company is an absolute master at generating huge profits from the money it invests in the business.
Next up, a balance sheet that's like a fortress. Its debt-to-equity ratio is almost 0. That means the company is pretty much debt-free. In a world where interest rates are rising, having no debt is a massive, massive advantage. It's all profit with no big interest payments eating into it.
And the good numbers just keep on coming. A 3-year average return on equity of over 40%. This is another top-tier metric. It shows you just how good the company is at generating profits for its shareholders. It's a direct measure of how much value they're creating.
Now, let's look at the more recent trend. This table here tells a really clear story. Just focus your eyes on that YOO growth row. See how it's accelerating? From 4% in Q1 to over 18% by Q3? The report argues this is the real story the market is missing. Not just growth, but accelerating growth, with profits climbing right along with it.
So let's recap. We have a monopoly with elite financials and growth that's picking up steam. This brings us right to the core of the whole investment idea, the argument that this stock, despite everything we just saw, is on sale at a rare discount. And here is that valuation argument in a nutshell. Historically, the market has been happy to pay a big premium for IRCTC, somewhere around 40 to 50 times its earnings. But today, that has collapsed to around 28 times. The report's big argument is that the business is just as good as it always was, but the price tag has been slashed. Of course, no investment is a sure thing. So to give you a balanced picture, the report is also super clear about the potential problems. What could actually go wrong with this whole idea? So the report actually ranks the key risks. And number 1, by a long shot, is a change in government policy. Now, it's a low probability event, but it would have a huge impact. The same government that grants the moat could, in theory, take it away.
Beyond that, there's the risk that lower margin parts of the business could grow faster, squeezing profits. And of course, the risk that the market just decides to give all government-owned stocks a permanently lower value.
And to bring it all together, the report uses this final scorecard. And as you can see, it's just a sea of green, zero debt, elite ROE and ROCE, clean promoter holdings. The only little amber flag, the only point of caution, is that government policy risk we just talked about.
And that leaves us right here with this final provocative question. You have a debt-free monopoly with fantastic financials, and it's trading at what this report calls a 40% discount. So, is the market's fear right now just noise, or is it a genuine opportunity? The answer to that question is really the heart of this entire investment puzzle.